Good evening, everyone. Today I will be presenting on Harry Markowitz's seminal paper, Portfolio Selection, published in the Journal of Finance in March 1952. This work laid the foundation for modern portfolio theory and significantly impacted investment management. Let me give you a brief introduction to this paper. For Markowitz, investment decisions lack a structured approach to quantifying and managing risks. Markowitz introduced a quantitative framework to help investors construct optimal portfolios by balancing expected returns against associated risks. Before Markowitz, investment theory lacked a formalized method to quantify risk. Investment decisions were largely qualitative before his work. By introducing diversification, Markowitz provided a method to reduce risk by combining assets with different risk-return profiles. There are a few assumptions that Markowitz had to make. First, rational behavior. Investors made decisions based on rational calculations to maximize their satisfaction. Results the optimization goal, which states that the goal is to achieve the highest return for a given risk or the lowest risk for a given return. There's also risk measurement. Variance and standard deviation are used as the key measures of risks. Expected return represents the average return an investor anticipates from an investment. The variance or standard deviation indicates a higher risk, as returns are more spread out around the mean. Additionally, I'd like to highlight how Markowitz's framework simplifies the complex information about securities into these three critical measurements. There's also the idea of covariance, which is crucial in determining how combining different assets affects their portfolio's overall risk. There's also the idea of risk reduction. Combining assets with low or negative covariances can significantly lower portfolio risk. There's also the concept of diversification, which means combining assets with different risk-return profiles can reduce the overall risk of the portfolio. An asset with high risk but low correlation with the rest of the portfolio can lower the portfolio's total risk. For instance, if you own an apartment in NYC, buying gold as an asset could reduce risk since these two assets have low correlation. As you can see, this chart plots different assets with return on the y-axis and risk on the x-axis. We see that the lowest return and risk is from the 30-day Treasury bill in the bottom left quadrant of the chart. As we move up and right, the U.S. government bond are depicted on the chart, moderate return and moderate risks. Stocks, specifically the S&P 500 index, has higher risk than bonds, but also higher returns. This makes sense. Small stocks are even riskier than the S&P 500, but have higher returns commensurate with that risk. Let me continue on with the practical application. The performance of an individual stock is not as important as the performance and composition of an investor's entire portfolio. The use of diversification to construct optimal portfolios. Simply owning lots of securities is not enough, though. One must diversify across industries, work with different economic characteristics. To build a genuinely diversified portfolio, you need to understand the economic fundamentals of a business. All the information needed to choose the best portfolio for a given level of risk is contained in three simple statistics: mean, standard deviation, and correlation. Thank you so much, and I hope you enjoyed this video.